I'm Darius McDermott from FundCalibre. Today I'm with John Gumpel, Portfolio Manager of the Brooks MacDonald Defensive Capital Fund. John, not many investors will know a lot about Brooks MacDonald. Can you tell us a bit about the origin of the fund management business and how it's developed out of the rest of Brooks MacDonald's business?
Sure. So Brooks MacDonald is an independent, publicly listed investment manager. We've got approaching 10 billion of funds under management. We're a multi-asset specialist, and the specialist funds division has really grown out of the wider multi-asset investment business.
Defensive Capital is a multi-asset fund, but it looks for investments with predictable returns. Can you tell us a bit more about that and give us an example or two, please?
Yeah, I mean, it's called the Defensive Capital Fund, so we're looking for defensive assets with attractive capital returns. So, for example, things like government bonds at the moment might be defensive, but they're not giving us attractive enough returns in order for us to consider them. So, by comparison, if we're looking for defensive fixed rate investment, fixed return investment, we'll be looking at a well-covered preference share, for example, that might have assets of 5 times the amount of preferential or protected return of assets to provide the return, and maybe is giving us a yield of 2 or 3% above the equivalent gilts. So there we're getting the defensive nature with the attractive capital return. So that's an example of a sort of defensive investment. Where we're looking to take on risk, we're very much focused on trying to cover our downside. So we like either to buy assets where the risk is already in the price, so things like the discounted assets. We're quite focused on a wide range of assets that we can buy at deep discounts that give us, we believe, attractive returns with the risk already in the price. Therefore, there's maybe more limited scope for downside and greater scope for upside. The other type of asset we use when we want to take on some risk are assets that protect their downside. So in a sense, something like a convertible bond is giving us the protection of the bond nature on the downside, usually covered by a high level of good quality assets, but is also giving us equity, some form of equity upside. So we're able to get the upside potential return with the additional protection.
Tell us how you use the fund in your own portfolio and what type of investor the fund might appeal to.
In my own portfolio, I use this as a core holding, just to sit there and provide me with hopefully attractive returns and a degree of defensiveness should markets turn a little bit more volatile or dangerous than they currently would seem. I mean, we sit in the absolute return sector, and our name is Defensive Capital, so we are clearly a defensive fund, but we are looking to provide, as I said, attractive returns. So we can probably be considered by quite a wide range of investors. Maybe people who are concerned about rising interest rates and maybe are worried about their bond funds might look at us as an alternative without the same interest rate risk. People that are frustrated with hedge funds or other absolute return funds that aren't providing attractive returns might look at us as an alternative, or just as a long-term, slightly higher risk alternative to cash. I mean, we have provided 7 years of positive returns since launch. So we clearly we haven't got quite the same volatility as markets, and so possibly might be attractive for people who are looking, for a slight move up the risk scale from the most defensive, as well as people that are looking to move away from sectors that or markets that they think are overvalued.
John, thank you very much.
Great, thank you.